You know, most people think investing is about luck, timing, or finding the next hot stock. But let me tell you, it isn't. I've spent decades watching markets rise, fall, and crash, sometimes faster than anyone could imagine. And through all of it, one truth has remained constant. The way to build real wealth isn't about chasing hype. It's about preparation, patience, and owning the right assets. Benjamin Graham taught this decades ago, and his principles remain as powerful today as they were back then. Imagine a market collapse where panic grips everyone around you. People are selling, losing confidence, and watching their life savings disappear before their eyes. The temptation to act is immense. But here's the thing. The most successful investors aren't reacting. They're calmly assessing, calculating, and acting only when opportunity knocks. Graham called this value investing. It's about recognizing real value and having the discipline to act when the world is in chaos. First, let's talk about cash. Most beginners think cash is useless because it doesn't grow like stocks or real estate. But here's the secret. Cash isn't an investment, it's ammunition. Think of it like a weapon in a battle. When everyone else is panicking and selling off quality assets at a fraction of their value, the person holding cash can strike, acquiring amazing assets at unbeatable prices. Without cash, you're powerless. You can only watch opportunities pass by. Consider the 2008 financial crisis. Banks were collapsing, companies were failing, and fear dominated the markets. Investors who were fully invested panicked. They had no flexibility, no ability to capitalize. Meanwhile, those with cash waited patiently. They purchased stakes in distressed, but fundamentally strong businesses at prices that seemed absurd at the time. Within a few years, those same investments multiplied many times over. Cash provided freedom, options, and ultimately wealth. But how much cash is enough? You need a safety net, at least 6 months of living expenses in reserve. Beyond that, think strategically. Keep between 10% to 30% of your investable assets in cash. When the market is euphoric and overpriced, hold more. When prices are low, deploy it. Discipline is everything. Cash in the right hands can turn fear into opportunity. Next comes high-quality businesses. These aren't just any companies. They are the resilient, enduring, cash-generating machines that survive every crash. Look for companies with strong competitive advantages, wide moats, trusted management, and products people need regardless of economic conditions. Coca-Cola, for example, has weathered decades of market turbulence. People may spend a little less during a recession, but they still drink Coke. That reliability translates into consistent cash flow and a stock price that eventually reflects the true value. Owning low-quality businesses is risky. They may look cheap, but if they collapse, your investment can vanish. High-quality businesses, on the other hand, are like ships built to survive storms. They keep moving forward, even when the ocean is rough. Patience is key here. Resist the urge to panic sell. Hold, trust, and watch time work in your favor. Over years, decades even, these businesses grow wealth steadily. Bonds might seem boring to some, but they are the unsung heroes of stability. Stocks are volatile, and crashes can wipe out huge portions of your portfolio. Bonds, especially high-quality government bonds or top-rated corporate bonds, act as a cushion. When stocks plummet, bonds often hold steady or even rise. They're not glamorous, but they protect you from the emotional roller coaster of investing. As you age, bonds become increasingly important. If you rely on your portfolio for income, you cannot risk a 30% loss in stocks. Bonds provide safety and peace of mind. Finally, let's explore real assets. Things that have intrinsic, tangible value: land, real estate, infrastructure, commodities, and productive businesses. These assets cannot vanish into thin air. A farmland producing crops during a recession is still valuable because people will always need food. Real estate in prime locations continues to hold value, providing rental income even during market downturns. The beauty of real assets is that they form the foundation of your wealth. Floor that can't drop to zero. The magic happens when these four assets, cash, high-quality businesses, bonds, and real assets, are combined. Cash gives flexibility. Businesses offer growth. Bonds provide stability. Real assets create a foundation. Together they form a fortress. This balanced portfolio doesn't just survive crashes, it thrives. You don't need to predict the next crash or time the market. You simply need preparation, discipline, and patience. I remember the COVID crash in 2020. The market fell 35% in just a month. Panic was everywhere. But by following Graham's principles, holding cash, investing in resilient businesses, maintaining bonds, and relying on real assets, I navigated it calmly. I could buy opportunities others could not, and within months, the portfolio had recovered and grown even stronger. Those who panicked sold at the bottom, losing money permanently. It's a harsh lesson. Fear destroys wealth. Preparation builds it. Now let's discuss the psychology of investing. Crashes aren't just financial, they're emotional. When your portfolio drops 30% or more, panic is instinctive, but human nature can be your enemy. The key is confidence. Confidence comes from knowing you own quality assets, that your portfolio is diversified, and that you have cash to seize opportunities. Emotions drive most investing mistakes. Panic selling, greed buying, following the crowd. Preparedness neutralizes fear and empowers rational decision-making. You see, the real secret to wealth isn't intelligence or luck, it's survival. Outlast the crashes, maintain discipline, and use the opportunities wisely. Graham's principles are timeless because they focus on preparation, not prediction. Investing isn't about brilliance. It's about endurance. Those who survive and act during crises are the ones who get rich. And let's not forget, opportunity and risk are inseparable. The market may crash, but within that chaos lie incredible opportunities. You can acquire world-class businesses at a discount. You can secure high-quality bonds yielding steady income. You can buy real assets that continue to generate returns. But these opportunities only exist for those ready, for those who hold cash, have patience, and understand value. When you build a portfolio using these four pillars, cash, high-quality businesses, bonds, and real assets, you create more than just protection. You create options. Options to act when fear overwhelms others. Options to buy exceptional assets at prices that seem impossible, and options to grow wealth even during chaos. The beauty of this approach is that it works in any market, in any country, and under any economic condition. Whether you live in the UK, USA, or Canada, these principles remain the same. Markets fluctuate, economies change, but value, quality, and preparation endure. Let's examine how to recognize high-quality businesses more closely. A great company is not defined by stock price or hype, it's defined by fundamentals. Look for businesses with a moat, a defensible advantage that competitors cannot easily replicate. This could be brand loyalty, patents, network effects, or economies of scale. Companies like Coca-Cola, Procter & Gamble, or Johnson & Johnson have wide moats that make them resistant to market shocks. Even during recessions, they continue to generate revenue, and their stock price eventually reflects this underlying strength. Next, analyze cash generation. Earnings on paper don't matter if a company isn't generating real cash. Cash flow fuels dividends, funds expansion, and ensures survival during difficult times. High-quality businesses maintain strong cash reserves and have a history of profitability that isn't dependent on market cycles. Pair this with competent, trustworthy management who think like owners, not just employees, and you have a resilient investment. During the 2000 tech bubble, countless startups vanished overnight. People invested in ideas rather than fundamentals, chasing dreams instead of reality. Those who owned companies with proven products, cash flow and solid management weathered the storm. It wasn't about luck, it was about understanding value and being disciplined. When the dust settled, these survivors were stronger and more profitable than ever, while speculative companies disappeared. Bonds also play a critical role here. Many underestimate their value, especially in bullish markets where everyone is chasing growth. But when markets decline, bonds act as a counterbalance. Government bonds, particularly in stable economies, provide consistent returns and reduce portfolio volatility. Even some high-quality corporate bonds can offer both income and security. By holding bonds alongside stocks and real assets, you smooth out risk and maintain peace of mind, especially as you approach retirement. Real assets, though often overlooked, are perhaps the most underrated piece of this puzzle. Land, infrastructure, and productive businesses provide tangible value. Unlike stocks, their worth doesn't rely on market perception. Farmland continues to produce food, utilities provide essential services, and infrastructure generates income regardless of economic cycles. These assets act as a floor for your wealth, a foundation that cannot vanish. Let's illustrate this with a story from my own experience. During the 2008 financial crisis, many investors were panicking. Stock prices fell dramatically, banks were collapsing, and trust in financial institutions hit rock bottom. Yet with a portfolio built on these four pillars, I could act decisively. Cash allowed me to invest in Goldman Sachs when it desperately needed capital. High-quality businesses in my portfolio like Coca-Cola and American Express remained resilient. Bonds cushioned volatility, and real assets like railroads and utilities continued generating income. By the time markets stabilized, these investments had multiplied in value. While many lost confidence, those prepared with balance and discipline were rewarded enormously. What separates successful investors from those who fail is emotional control. Crashes are stressful, but emotional reactions destroy wealth. Panic selling during the COVID crash cost many investors tens of thousands, sometimes hundreds of thousands. Meanwhile, those who remained calm, relied on cash reserves, and invested strategically profited handsomely. Discipline and preparation allow you to act rationally, even when fear dominates headlines. The importance of patience cannot be overstated. The market doesn't reward impatience, it rewards discipline and consistency. Buying high-quality businesses at the right price and holding them over years, even decades, compounds wealth exponentially. Compounding is not just a mathematical principle, it's a psychological one. Resist the urge to chase short-term gains. Trust that your strategy, grounded in Graham's principles, will deliver superior long-term results. Diversification also plays a crucial role in reducing risk. Spreading investments across different asset types, cash, stocks, bonds, real estate, and commodities, ensures that no single collapse can destroy your wealth. Think of it as constructing a fortress. Cash gives mobility, businesses supply growth, bonds provide walls, and real assets form the foundation. Each pillar supports the others. Weakness in one area is counterbalanced by strength in another. Here's a common mistake. Investors often assume they need to predict the next crash or identify the perfect stock. That's a trap. Crashes are unpredictable, and stock picking is notoriously difficult. The key is preparation, not prediction. Have the right assets in place, maintain discipline, and focus on value. The market will provide opportunities, but only if you're ready. Those who wait, who stay patient, and who act decisively when fear is high, consistently outperform. Those who chase trends, Let's discuss how to deploy cash during opportunities. During market turmoil, prices can drop dramatically, sometimes 30%, 40% or more. These are moments when high-quality businesses, previously unaffordable, become accessible. Investors with cash can acquire these companies at discounts unheard of during stable markets. Remember, this isn't gambling, it's buying value at a lower price. You're purchasing future growth at a fraction of the cost. Timing matters less than having liquidity ready to act. Another essential aspect is understanding risk tolerance. Every investor has a unique capacity for risk. Some can endure high volatility, others prefer stability. Graham's principles aren't rigid formulas, they're adaptable. Adjust the balance between cash, bonds, stocks, and real assets based on personal circumstances. Younger investors might favor growth through equities and real assets. Older investors, or those nearing retirement, benefit from stability through bonds and cash reserves. Adaptation ensures both safety and growth. It's also vital to distinguish between investing and speculation. Investing involves careful analysis of intrinsic value, cash flow, and durability. Speculation is driven by trends, hype, or emotion. The latter may yield short-term gains, but it's a dangerous game that often leads to disaster. Graham emphasized margin of safety. Always invest with a cushion, knowing that the asset can withstand market stress. This philosophy is timeless. It's what allowed investors during the Great Depression, the dot-com crash, and the 2008 crisis to survive and thrive. Over decades, one lesson stands above all. Survival is the ultimate path to wealth. You can make brilliant picks or stumble upon lucky trends, but without surviving market cycles, nothing else matters. Crashes aren't just challenges, they're opportunities in disguise. With the right mindset, liquidity, and asset mix, every downturn can become a chance to strengthen your financial position. Those who panic miss out. Those who prepare capitalize. Even now, markets are volatile. Headlines are filled with fear, speculation, and uncertainty. But remember, chaos is a natural part of investing. You cannot control the market, but you can control your response. By holding cash, owning resilient businesses, maintaining bonds, and investing in tangible assets, you control your destiny. You turn unpredictability into opportunity. And most importantly, you create peace of mind, knowing that no matter what happens, you are prepared. By now, it should be clear that these 4 pillars aren't optional, they're essential. Each one complements the others. Cash provides the ability to act. High-quality businesses provide growth. Bonds provide stability. Real assets provide a foundation. Ignore anyone and the system weakens. Embrace all 4 and you have a fortress. A fortress that not only survives crashes but thrives through them. When markets falter, everyone panics. The majority sells. Prices plummet. That's when the prepared few step in. With cash ready, they acquire undervalued businesses. With bonds, they remain secure. With real assets, they maintain a floor. And over time, the results are dramatic. Wealth isn't created by chasing the latest trend. It's created by being prepared, patient, and disciplined. As time passes, the most important lesson becomes clear. Wealth isn't built in a day, but over decades of discipline and patience. Crashes come and go, markets fluctuate, but those who maintain a strong foundation survive and eventually thrive. You see, when you've structured your portfolio with cash, high-quality businesses, bonds, and real assets, you're not just investing in money, you're investing in peace of mind, control, and freedom. Think about it. Most people let fear dictate their actions. They see a 30% drop and panic. They sell at the bottom, locking in losses, regretting their decisions for years. Others follow the crowd, chasing trends, hoping for quick gains. But wealth isn't about luck. It's about preparation and strategy. The 4 pillars I've been describing aren't just concepts, they're your shield against uncertainty, your guide through the chaos. Let's revisit opportunity during crashes. When the COVID crash hit in 2020, many investors fled the market, selling high-quality assets in fear. Those who had cash and courage saw the opportunity. Stocks of resilient companies became available at deeply discounted prices. Bonds held steady. Real assets continued producing value. Within a year, the market not only recovered, but soared to new highs. The lesson is clear. Panic leads to losses. Preparation leads to wealth. High-quality businesses are particularly fascinating during downturns. While weaker competitors falter, resilient companies continue to innovate, gain market share, and strengthen their positions. For example, a business like Amazon, even during recessions, continues to grow because it serves real needs, has operational excellence, and dominates its sector. Owning such companies is like holding a ship built to survive any storm. You might see temporary dips in stock prices, but the underlying value remains intact and eventually reflects in higher wealth. Bonds, although often overlooked, provide emotional and financial stability. When stocks crash, bonds often rise or hold value, reducing overall portfolio volatility. This stability allows you to make rational decisions rather than emotional reactions. It's not glamorous, but in investing, glamour rarely builds lasting wealth. Safety and consistency do. Real assets form the anchor of your portfolio. A piece of farmland, a rental property, or a company with physical infrastructure continues to generate value, no matter how markets behave. Unlike paper assets, they cannot disappear overnight. They provide income, security, and a tangible floor for your wealth. This isn't speculation, it's reality. In times of uncertainty, real assets are your lifeline. Now consider the power of cash combined with discipline. Without cash, you can't act. Without patience, you can't capitalize on opportunities. When markets are in panic, cash allows you to buy great businesses at prices others only dream of. It's counterintuitive, but during fear and chaos, the prepared investor gets richer while others lose. Timing the market is a fool's game. Being ready with liquidity is what wins. Over decades, one pattern repeats itself. Those who survive crashes repeatedly come out stronger. This isn't magic. It's the combination of strategy, preparation, and emotional control. Benjamin Graham's wisdom shines here. Invest with margin of safety. Focus on intrinsic value, and don't let emotions dictate decisions. When the next inevitable crash arrives, those who have these pillars in place will have the confidence to act, the ability to endure, and the opportunity to grow wealth exponentially. Let's talk about psychology, because this is where most investors fail. Fear and greed are natural instincts. Crashes amplify fear. Bull markets amplify greed. Most investors make decisions based on headlines or emotions, not fundamentals. By having a balanced portfolio with cash, high-quality businesses, bonds, and real assets, you counteract these impulses. You create a rational framework that guides decisions instead of panic. Confidence, knowledge, and preparation neutralize fear. Here's an example. During the 2008 financial crisis, many sold their assets at huge losses. They watched their wealth evaporate and regretted it for years. But those who had cash and patience bought stakes in strong companies like Goldman Sachs or General Electric at fractions of their value. These investments later returned multiples of the initial capital. The market punished the unprepared and rewarded the disciplined. That's the reality of investing. Survival plus opportunity equals wealth, and it doesn't stop there. Wealth built this way compounds over time. High-quality businesses reinvest profits, real assets appreciate, bonds provide stability, and cash positions allow continued growth during downturns. The effect multiplies over decades. You're not gambling on luck. You're leveraging the consistent, reliable principles of sound investing. One of the most overlooked aspects is adaptation. Your portfolio should evolve as you age, as markets change, and as opportunities arise. Younger investors might favor growth through equities and real assets. Middle-aged investors balance growth with bonds. Older investors emphasize stability and income. The principles remain constant, but the allocation adapts. This flexibility ensures you survive every stage of life and every market cycle. It's also crucial to understand risk versus opportunity. Crashes are terrifying, but they're also when the best opportunities appear. Prices drop, panic spreads, and the world overreacts. High-quality assets become available at discounts. Investors with liquidity and courage can acquire them, building a foundation for future wealth. Fear destroys wealth. Preparation creates it. By now, the picture is clear. 4 pillars, built and maintained correctly, create a fortress. Cash gives flexibility. Businesses provide growth. Bonds supply stability. Real assets offer a floor. Alone, each pillar is valuable. Together, they're unstoppable. You're not predicting the future. You're prepared for it. Crashes may hurt, but they won't destroy you. In fact, they'll often become your biggest opportunity. Imagine looking back 10, 20, or 30 years from now. The market will have crashed multiple times. Headlines will have screamed disaster. Fear will have gripped most investors, and many will have lost fortunes. But you'll have acted calmly, acquired assets at discounts, maintained your foundation, and grown wealth steadily. You'll understand that the secret wasn't luck or timing. It was preparation, discipline, and patience. The same principles Benjamin Graham taught decades ago still hold. Here's the final truth. The key to wealth isn't brilliance, it's endurance. Survive the crashes, own quality, maintain cash, use bonds wisely, invest in real assets, avoid emotional decisions, stick to fundamentals. Over time, this approach compounds, protects, and grows wealth in ways that speculation, luck, or timing never can. So what should you do today? Build your fortress. Start by assessing your cash reserves. Acquire high-quality businesses you understand. Add bonds for stability. Invest in real assets for a tangible foundation. Keep adjusting as life and markets change. The next crash is inevitable. It's not a matter of if, but when. And when it comes, you'll be ready. Calm, prepared, and positioned to profit while others panic. That's how you survive. That's how you thrive. That's how real wealth is created. When I reflect on my own journey, it's never been about being the smartest or the fastest. It's about staying in the game, making disciplined decisions, and acting only when opportunities align with value. Every crash was a test, and every recovery a reward for patience. Benjamin Graham's principles are timeless because they teach the same lesson. Survive, prepare, and act with discipline. So take this advice to heart. Build the fortress of 4 pillars: cash, high-quality businesses, bonds, and real assets. Protect yourself. Seize opportunities. Maintain discipline. Stay patient. When markets panic, you'll be ready. You'll act while others freeze. You'll grow wealth while others suffer losses. And years from now, you'll look back and realize that true financial freedom wasn't about chasing trends or predicting crashes. It was about preparation, patience, and consistent, disciplined investing. In the end, that's the legacy Benjamin Graham left us. A roadmap for surviving the storms, thriving in chaos, and building lasting wealth. Follow it, respect it, and your financial life will be transformed forever. Crashes are inevitable. Losses are optional. Discipline, preparation, and the right assets are everything. Build your fortress, and no storm can shake it.